Greetings, ladies and gentlemen, and welcome to the Equity.Guru Investor Roundtable. As part of our Education Wednesday, we are having the professorial edition of the Equity.Guru Roundtable. Remember in the old days when glasses meant you were smart? When you had to wear glasses, they go, hey, that guy must be smart. Well, look at all of us wearing our spectacles. That's because we are smart. At least those three are. That's Galen in the basement. That's Fabi in the far corner from Portugal. She's actually in Portugal. And Vishal in his gold vault, showing off as usual, his riches. We're going to cover different elements of investing today. And Professor Dr. Galen Ingen is going to start the proceedings, please.
All right. Well, I'm neither a doctor in medical or university terms. I'm just me. I don't want to put forward any false pretenses here. All right. Okay. A lot of difficulty that investors encounter come from sort of general ignorance of the sector that they're trying to invest in. And that can be a real detriment in highly technical sectors such as resources and mining in particular, because much of it is based on geological jargon that you wouldn't understand unless you took 4 years of university and were breaking rocks on a regular basis with your little hammer and looking at stuff inside. It takes a while, but you can educate yourself in the deeper and more technical aspects. But for the most part, there's some general things that I'm going to touch on because the rest of the guys here have a much broader and deeper experience with this particular sector than I do, and they're going to get into the weeds. And I'm just going to sort of take a 30,000-foot view and from a newbie standpoint. You have different levels of mining in terms of the companies that you can invest in. You have your early explorers, you have your advanced stage explorers, and then you have your producers. Now, let's just start with the early stage, because that seems to be where people think it's where the most growth is there, but it's also where the biggest risk is.
Yeah.
Now, basically, these early explorers, and there's different stages of them as well. Let's just say that you're going to a company that's just purchased a property. They've got historical data, meaning that the data that they have on what's there was conducted by somebody else, a previous owner. So they can't really say that it's there, but they have a pretty good indication that it might be, and they can continue their progression forward. At this point in time, as an investor, yes, you're looking at this historical data, absolutely, and that does give you some indication that things are there. You're also considering something that they like to call as closeology, meaning where they're situated. Are they around a bunch of other really big mines that are producing already? Because chances are the geology is similar, and there may be some deposits where they're at that they can play with, or some extensions from another property that may actually carry into theirs that they can tap into. So this is something to consider. But probably the biggest thing, or one of the most important things, is look at who's behind the wheel.
Yeah.
It really comes down to management and experience. Right? If you're coming to somebody that has spent the last 5 years keeping the lights on in the company and they haven't really done anything to explore the property, you probably want to steer clear of this. They'll continue to say every time it turns around for quarterly reports or when they start to want to do a financing that, oh my God, you should see the stuff that we've got here. We're going to get there eventually. We've just had trouble spinning up our exploration work. And these are the people that you want to stay away from. Typically, when you look at a company that's in early exploration or in relatively early exploration, let's not talk about people that are just starting. If they haven't done anything with the property in the last 3 years, they're never really going to do anything with the property. There might be stuff there. They may have a good crew, but for some reason, they ain't following through. You really want to look at people that are actually actively exploring their property, whether that be geological sampling or even thankfully putting drills in the ground. Once that starts happening, you really get a solid picture of what's actually going on with the company. So check the pedigree of the management. Have they done this before? Have they worked at this particular area before? Because geology is different all around the world. So is mining different minerals. So if they've got an experience with gold in Mexico and they're drilling in Mexico or they're trying to explore in Mexico and they've got 10 years of experience already doing it or better, and they've had a success record, perhaps they took another company into an acquisition state where they got gobbled up by a bigger major, or they even took it to production and walked away and are now starting again, or have had an ability to raise a lot of money. These are the things that you look at. Is the management solid? I think that's one of the biggest important points to talk about. And I went over my time. I'm going to step away very quickly.
You're good. You're good. You're right in the ballpark. Now, this is going to be a pun, but we are going to take the mining and resource discussion a little deeper with Fabi, who is a uranium expert and can talk a little bit about more specific analysis as you're moving ahead.
Well, thank you, Rob. I don't know if I would call myself an expert, but I've lost some money, so I guess that makes me something in uranium. I've also gained some money, so I guess we're doing all right. So what I would like to bring to light regarding uranium is that in order to understand the uranium market, you have to go a little bit deeper than just something that you would do, for example, copper, for silver, and for gold. Reason being, when you look at, for instance, gold, you look at supply and you look at demand, and those two numbers will either match very rarely or one will surpass the other. And then you'll be thinking, okay, maybe we're in a deficit, maybe we're in a surplus, and then you can make your decision based on, do you believe there will be too much gold in the future, not enough gold, et cetera, et cetera. When it comes to uranium, that's very, very difficult to do if you just look at those two different numbers. Reason being, one of them is that the spot price or the price of the trading uranium on a daily basis is more of a trader's game. It's more of a financial game. Real utilities using uranium for nuclear power plants don't usually buy that much into the spot market. So those numbers don't really reflect what they're paying. They do influence it to a certain extent. It's not that it's not important at all, but it's just to keep in mind that the price of uranium that you see quoted, the spot price, is not exactly the same as contracting price. That's the important stuff. It's not easy to get that contracting price. And obviously some companies want to keep it under wraps because they don't want to reveal that they're maybe contracting for not enough money, or maybe utilities are paying too much. And so, both sides want to keep it quiet. The other thing that you have to keep in mind is that a lot of uranium secondary supply has been a drag in price, bringing the price down for many, many years. And I'm just going to try to compare this to a factory where you're supposed to make orange juice, right? So imagine you're making orange juice and you got lots of oranges, but it's really quiet, right? Like not all your machines are busy right now. So what you do is you can squeeze more orange or more orange juice, get more orange juice out of the same oranges just by spinning the machines again and squeezing a little bit more, right? So that means that you kind of need fewer oranges when it's quiet, right? That's what happened to uranium for many, many years. The problem is, if you're too busy, if there's too many people wanting orange juices, then guess what? You can't spin that much because you got to get the product out really quickly. That means that you need more oranges to produce the same amount. And that's what's happening right now in the secondary market for uranium, which means the stuff that was weighing down the price is now a reason for it to go up. You're going to see that in the contracting cycle that's going to begin now. More and more players coming to the market, utilities starting to understand that prices might go up soon. And then eventually that will be reflected in the spot price as well, but just not yet. So don't wait for the spot price to be the indicator of prices going up and down, but watch many more suppliers announcing new contracts. That's the big telltale sign.
Very good. And that transitions beautifully into Chartman.
Yep.
Who will explain the catalyst factor and how that converts into dollars and cents.
For sure. And, you know, I want to say what Galen said. That's usually my approach. You look at good management and you look at good jurisdictions, you know, the non-AK-47 countries we've talked about. Look at, you know, really good projects. You guys know my approach is sort of more trading. A lot of my success with the junior miners have actually come through trading rather than, you know, holding long-term. My approach for investing in gold and silver for the long term is owning the royalty and streaming companies, just because you know, they do well, or they can provide catalysts in a down market or in an up market. They pay dividends, less costs, right? There's a lot of benefits of holding a royalty and streamer company. But at times, you know, I tend to trade the juniors for what we call not necessarily a day trade, but a swing trade. So holding for maybe a couple of weeks or maybe a couple of months. And for that, the charts are quite important. And I say that because obviously there is a correlation between, say, the price of gold, the price of silver with a silver miner or, you know, a gold miner per se. Right now, the most important thing that a lot of people are watching is, of course, that US dollar chart, just because there tends to be an inverse correlation between the dollar and gold. So when the dollar is going up, gold is going down. It's not always the case, because there are cases where when there is a lot of risk and I guess you could say uncertainty, both of them can move up together for some time in a process called, I guess, a confidence crisis. But generally, there's, you know, that inverse correlation, and you know, you're sort of seeing that right now with the price of gold, the price of silver as well, breaking major support levels. So I'm forecasting a bit more pain in some of these mining stocks right now. And what I would be watching for some sort of reversal sign are the charts of GDX and GDXJ. And these are ETFs. GDX is an ETF for gold miners, and GDXJ is an ETF for junior gold miners. So it's this portfolio of gold miners or juniors. And generally, that's the chart that I use to look for a bottom. When I see, you know, the chart beginning to range, it's telling me that maybe there's some signs of selling exhaustion. Obviously, you're not seeing that right now, but maybe there's some hope here where we can see the GDXJ and the GDX begin to range. And that's when I will tend to look for some juniors for a swing trade. So as a trader, US dollar chart, GDX, GDXJ, of course, watch gold and silver, because I think these charts are obviously not looking too good, but nothing moves down forever, nothing moves up forever. It tends to move in cycles or in waves. And I think, you know, there's going to be an opportunity to buy the bottoms in maybe a few weeks or a few months' time.
Boy, like true intellectuals and disciplined professors, you guys were spot on your times. Like, this is impressive. It's like bang, bang, bang. Any comments? We're not handing out money because this is not an investment situation on a sector or a company. We'll have a really cool one coming up with these three folks shortly with some scandiums. What? That'll be on the site here shortly. But any comment on to add or, you know, support or retract or whatever on anybody else's comments? Anybody want to chip in anything on anybody else? Comment on the other professor? Or we're all being cordial?
No, I agree with Vishal in terms of gold and silver. They're getting pretty beat up right now. I would wait a little bit and see how they pan out over the next few months.
All right. We will be back shortly. If you're seeing us this day, you might see us with another couple of little roundtables coming up on some really wicked cool companies. So check around the site because we're going to be here. For Galen, Vishal, and Fabi, I'm Rob. We hope you've learned something today, and we look forward to talking to you on the next Equity Guru Investor Roundtable.